Hi friends, in part 1 of this video, we had discussed the possibilities of revival of the NBFC sector. In this video, we will discuss two stocks whose fundamentals have been improving and their fundamentals are seeing a turnaround post the COVID-19 pandemic. We at Sharekhan Education have researched these stocks. So let's discuss a brief view on these stocks. The first stock is Cholamandalam Investment and Finance Company Limited. Cholamandalam Investment and Finance Chola is a comprehensive financial services provider with a diversified product portfolio across vehicle finance, which is 73% of AUM, home loans, home equity loans, 17% of AUM, SME loans, 6% of AUM. Then there are businesses like investment advisory services, stockbroking, and other financial services. During the last 5 years, the company has established a credible operational and financial track record as manifested by superior AUM growth at 20% CAGR and a growth of 19.8% CAGR in EPS. The AUM growth was 6% year-on-year in Q3 FY22, continuing its increasing sequential trend from Q1 of FY22. The management expects the AUM growth to be 10% in FY22 and range between 16 to 17% in FY23 and FY24. Loan against property and home loans are the key contributors to the AUM growth. Quarterly repayments have also been witnessing a rising trend sequentially. A faster recovery of the rural sector and a good Kharif harvest is expected to drive rebound in rural demand. Chola is expected to benefit as it has around 80% of branches in rural and semi-urban areas. The company has been seeing a strong sequential trend on disbursement backed by vehicle financing and loan against property. Disbursements surged from Rs 36 billion in Q1 FY21 to Rs 104 billion in Q3 FY22. Management is most bullish on the used vehicle segment, while it is cautiously optimistic on the car segment given the semiconductor shortage issues. In the recent quarter, due to change in RBI norms, gross non-performing loans were higher at 8.53%, but having said that, in the next 2 years, non-performing loans are expected to stay in the range of 4 to 5%. Also, in spite of the elevated credit costs and operating expenses during the last few quarters, its net interest income is expected to grow at a CAGR of 15% over FY21 to FY24. Chola has forayed into 3 new businesses focused on retail and SME lending to disburse secured and unsecured personal and business loans to be sourced through a combination of fintech partnerships, direct selling agents, and its own branches, thus improving disbursements, AUM growth, stable net interest margins, and reducing non-performing loans puts Chola on one of the most preferred stocks. Chola enjoys one of the best return on equity ratios of 17% against the industry peers, and it is expected to improve to 20% in the next few years on the back of also lowering leverage. Backed by its strong parentage of the Murugappa Group, the company derives considerable management, operational, and financial support, which will enable it to withstand any downturns in the industry and the economy. With the recent correction in the stock price, we believe the stock is undervalued and the stock looks attractive at demand zones of Rs 600 and 605 on the charts. The second stock that we would like to discuss is Mahindra and Mahindra Financial Services Limited. MMFS is a subsidiary of Mahindra with 51% promoter ownership, and it's a leading NBFC offering a range of financial services such as purchase of utility vehicles, which is 30% of the loan mix, tractors, 17% of loan mix, cars, 22% of loan mix, commercial vehicles, 16% of loan mix, used vehicle, 9% of loan mix, as well as construction equipment. It has a strong network of 1,322 branches spread across 25 states and 5 union territories in India. The company also provides loans for buying and renovating homes in rural India through Mahindra Rural Housing Finance, as well as offering insurance solutions to retail customers and corporations through Mahindra Insurance Brokers. Loan book has declined because of COVID-19, and that decline has now been arrested and it is expected to pick up in double digits from FY23 onwards. Disbursements have also picked up from Rs 39 billion in Q1 FY22 to Rs 80 billion in Q3 of FY22. Tractor disbursements, which are around Rs 15 billion, were close to Q3 FY19 levels, and MMFS has regained the number one position in the segment. With the recovery progressing well, we expect 30% year-on-year disbursement growth in FY23 off a low base, leading to 13% AUM growth. MMFS costs of funds declined 50 basis points quarter-on-quarter to 6.7% due to refinancing of higher cost debt. Net interest income rose 12% year-on-year owing to net interest margin expansion of 1.6 percentage points year-on-year during Q3 FY12, and provision reversals continue aiding profits. MMFS has already reversed Rs 14.4 billion of provisions made earlier and is expected to continue the reversals going forward. Asset quality improved across different stages of loans, leading to a write-back of provisions. But Q4 FY22 will see a one-off hit to credit costs in Q4 due to the RBI norms for non-performing loans. Healthy recoveries, reducing non-performing loans, reversals of provisions, and reduction in credit costs all lead to improvement in ROE from 2.1% currently to about 13% by FY23. Strong parentage will support the company in any possible downturn in the industry and the economy. Valuation of the company remains very attractive at 1.16 times forward price to book value on FY23 basis. The stock trades currently inside a yearly demand zone of Rs 168 to 62 on the charts. So that's all, folks. This is Viral Shah signing off. Happy investing. Please note, we do not give any recommendations or financial advice. We suggest investors do their own research or consult a financial advisor before investing.